Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Right now, David Bailin joins, Chief Executive Officer, CIO Capital, and of course, decades at Citigroup as well. What is the emotion that you see out there among investors, David? Is it truly the exuberance of a bull market?
There's no question, Tom, that we see the exuberance of a bull market. And I think that people are beginning to focus on 2026 and take a look at what's going to happen for earnings and things like that. And they are, they're pretty bullish on it. And I think what they're missing right now is that if tariffs are cleaned up, if we actually knew what the tariff policy was, we can have a very robust 2026. If we continue to have the kind of policy now that varies, we're going to see some real issues with two different parts of the economy. One, manufacturing slowing down and unemployment rising. And the second is that there are a lot of tech companies that if they don't get air under their wings will remain unprofitable in 26. And that could create an overhang in the market.
I look at my chart of the day, which was out on Twitter, and it's a huge investment contribution of AI computer software into our GDP. Is this a fictional buoyant economy? Is it a pretend buoyant economy?
No. It is not. This is, Tom, this is perhaps the most real investment cycle that we've seen since the internet boom. But the difference this time is we're building an extraordinary amount of infrastructure. Order of magnitude, $400 billion has been committed. This year alone, we've seen a 40% increase, right, in all of the related hardware and commitments for chips this year. Next year, we expect to see another growth rate. The market expects about a 10% growth rate in that area. We think it'll be more like 15% on top of that. And that's an enormous amount of capital. And then, of course, the impact of AI itself on business will take place after that. Not all of those investments are going to be successful, but they are going to transform the economy here in the United States and certainly in China. And that's happening right now. And those are both investable. And I think that what is countervailing that and what's making you doubt it, I think, Tom, and this is legitimate, is that you have a boom in this area, right? And you have a bit of a bust in two parts of the economy, one being in healthcare, and specifically, in the fact that healthcare shares are trading perhaps as bad as they have at any time in the last 20 years on a valuation basis. And the second is you're not seeing a pickup in manufacturing or manufacturing employment yet. And a lot of that, as I mentioned, is really tariff related.
David, you've done a great study of cash. What's changed, say, in the last 100 days?
Nothing, Tom. Cash is, in my mind, simply the most ignored part of the retail balance sheet and the family office balance sheet that I've ever seen in my entire career. Just to give you some numbers, family offices have somewhere between, on average, 9 to 9.5% in cash. The average yields that they earn on that are a little bit above 2%. They could be earning 4 to 4.5%. And it is simply something where there is just intransigent laziness on the part of investors. And frankly, I think part of this is on the part of firms that are not bringing this to the attention of their clients. I think it's very important that we treat cash like an asset class. That's something we're going to do at CIO Group from now on, and talk about the fact that if you're going to retain that large a portion of your balance sheet in cash, that there are ways in different parts of the market that you should be investing in far more aggressively than they have been.
David, we've got a Federal Reserve that's begun a rate cutting cycle here. What does that mean for the fixed income market? How are you guys thinking about that?
Right. We've been encouraging our clients to really think about having more of their capital deployed in the intermediate space, anywhere between 3 and 7 years. And they're going to get a higher total return over the course of the next 2 years by doing that. We think that the rate cycle itself will be extended. In other words, it's not going to come down quickly, but it will come down consistently over the course of 2026. And part of that, of course, is going to be the fact that the economy itself is going to be a little weaker, with the exception, Tom, of AI-related activity. And that's going to enable them to reduce rates. And all of this is part of a larger plan, which I think the administration really wants to see lower rates, which they've made very clear, but they're going to then do a lot of the debt refinancing in the U.S. looking at, the 5-year or less maturity. Right. And I think that's all part of a larger plan to mitigate, I think, what are very large deficits for the next several years.
David Bailin, thank you so much, with CIO Capital. Tiffany Wilding has never gone to 3 decimal points. If she did, they throw her out of that acclaimed meeting at PIMCO where she talks to the fixed income managers. I mean, I'm seeing a buoyancy, Tiffany. How do you do fixed income in a boom economy?
Well, I think that there's winners and losers right now in the economy, and that's the result of what I would call clashing of three policy pivots / cycles that are happening. So you have the tariffs that have come up quite a bit, more than any time in a century. You also have immigration policy that's done a U-turn, and underlying all of that, we have this tech boom that's also happening. So what does that mean? Well, it means the economy is adjusting, and certain parts of the economy do look like they're doing worse than other parts. I think the most interesting thing right now is the labor markets. If you look at the details of it, they do look quite recessionary. If you adjust the establishment survey for some of the overestimation issues that it's had over the past year or several years, it does look contractionary. But however, despite that, you have consumers, you have real consumption, that is still chugging along. You have real wage growth that is, still resilient around 1%. That's supporting consumption. And you have this AI capital boom that's happening under the surface as well. So there's a lot of on the one hand, on the other hand, not to be a two-handed economist, but it's an interesting economy right now.
And Tiffany, the inflation data that we just received at 8:30 this morning suggests that inflation's kind of in check here. There's nothing really to spook anybody, I don't think. What did you make of the inflation data?
Yeah, I mean, I think just taking a step back, we haven't seen this type of tariff adjustment in a century. So there was a lot of uncertainty around just how it would play out. We try to have some sort of historical benchmark, which suggests that, tariffs are passed through to prices. But the reality is when we look at the data right now, what's happening is that companies are passing some of it through, but much less than I think most people expected. Yeah. And where you're getting more of an adjustment is lower costs. Companies are trying to manage costs in other places. And one of those places is managing labor costs. And we think the clash of the AI cycle, is also allowing them to manage labor costs. You're already seeing tech, entry-level job hiring at tech firms start to slump. So the labor market is taking on more of this adjustment than I think most people expected.
What's your model number? I'm some fan, I think Jerome Schneider. I mean, he's only working like a 3-day work week. I mean, his idea long-term is 90-day paper. So you're talking to Jerome Schneider at PIMCO, legend in short-term paper. And Tiffany, you have to talk about the buoyancy of the economy. Is AI discrete, or is the American economy doing better?
Yeah, I mean, again, I think if you just look at growth rates last year versus this year, we have seen a clear step down in the pace of growth in the U.S. economy. We were growing, you could call it 2.5% to 3% over the last, not only last year, but over the last several years. And now we've stepped that pace down to what looks like a 1.5% to 1% pace. So clearly the economy is stepping down, but I think what's becoming more clear is that any economist, when you have that big of a move in growth, you have a deceleration in growth, you worry about that momentum. So you worry about the economy stalling. But it looks like, when you look across indicators, we are not seeing a stalling in the economy.
Exactly.
We're seeing growth that stepped down.
Where is the slowing economy? To me, Paul mentioned it earlier, it's just K-shaped. There's a part of America flat on their back. There's a part of America booming, wealth effect, whatever. You know the drill, Tiffany, better than I do. What does a Fed do? How does a Fed manage the polarity of the American economic experiment?
Yeah, I mean, I think that it's a really tough environment to be a central banker, for a lot of reasons. And I think how you balance this, all of these factors, is that you remind yourself, as most of them do all the time, that you're still above neutral policy. You still think you're restrictive, and you do have an economy that has slowed. You have a labor market that has slowed quite dramatically, and you have inflation risks that look less than they did before. And so what that means in our mind is that you can start cutting interest rates. Now because the economy doesn't look like it's stalling, we wouldn't go as far as to say recessionary cuts are needed. But starting that cutting cycle back to neutral makes sense to us. You get more information, you see how the economy is reacting.
When's the last time I did this, Paul? I just did a Fibonacci retracement.
Oh boy.
From the peak of the market on September 22. We had 3 down days in a row.
Yep.
I stayed solid because I was all in cash. We just hit the 50% retracement.
Yep.
In like a cup of Sanka. We just hit the 50% retracement going up of our 3-day debacle.
Boom,
it was a correction.
It was a correction for the ages. So, Tiffany, one of the areas that's a little bit concerning for, I think, consumers out there is the housing market here. Just the affordability of housing is such a problem for so much of this economy. How do you think about that?
Yeah, I mean, clearly the housing affordability issue is a very big issue. We would argue it's a political issue. When we look under the surface of the housing market, however, what we see is a housing market actually that has pretty decent fundamentals. Just in terms of leverage, equity in homes, and the fact that after the Great Financial Crisis, you had about a decade of underbuilding relative to population growth and demographics. So the housing market, from a supply-demand perspective, it's in a tight spot. So that's, not where it was at all before the 2008 financial crisis. But nevertheless, with COVID, you saw this very big run-up in prices, along with higher interest rates that's made housing much, much less affordable. So we need the economy, we need real incomes to basically grow into these housing prices. And our view is that you're probably going to have housing prices that are a bit more sluggish in terms of their appreciation over the next several years as you get that economy growing into them.
I mean, Tiffany, I know you live down the street from Antigua Way in Newport Beach, 92660. I got 4 bedrooms, 4 baths, 2,700 square feet. For Paul, that's a small abode. Clocking in at $4.2 million. Nice. I mean, the housing market is nuts. What is the most efficacious 10-year yield for you for American society? What yield would, not the bond guys at PIMCO, a legitimate economist, what's the best 10-year yield for America?
Well, I mean, I think this gets into this concept, that many people criticize, but is helpful for central banks of what is the neutral interest rate. And that's like the rate that the economy can handle. It's never, accelerating or decelerating. And I think there's a lot of debate around that right now. But many people think that a nominal kind of neutral interest rate of 3% is something that is more neutral for the economy. I mean, if you look at broader investment, not just housing, residential investment, which has been, very low, flat/contractionary. A broader set of investment in the United States is actually also flat to slightly contractionary outside of AI. So if you look at everything ex AI, it does look like monetary policy is restrictive. And so I think as a result of that, they have room to bring down interest rates. We think kind of a 3% level still makes a lot of sense to us. I know, Stephen Myron made a case for something lower than that. I think we just have to see, again, taking small steps, seeing how the economy reacts to that is what makes sense to us now.
It's Get Tiffany in Trouble Friday.
Okay,
that's what it's called. Tiffany, do you agree with the certitude Governor Myron has of a need for a shock rate cut down to a new regime?
Yeah, I mean, I think this is the key issue with monetary policy and central banking. The thing is if you're uncertain, the level of R star is uncertain. Anybody who's worked on the models that try to estimate these things understand how big of bands are around the point estimates and uncertainty. And if you're uncertain about anything as a central banker, what you want to do is move more slowly, and you want to take steps, and you want to see how the economy reacts. Now, the the reasons why you move fast as a central banker is that you're worried that inflation expectations are going to become unanchored. Inflation expectations look very stable, or you worry that the economy is going into recession, and then you want to move quickly. And again, as I mentioned before, there's a lot of data that suggests that, the economy, the growth rate has moved down, but we're not necessarily nearing a stall. So, again, I think all of that suggests that moving in a methodical way makes a lot of sense here for the Fed.
Brilliant, really complete. Thank you so much. Tiffany Wilding there as well. We've tried for 3 days to get Aoifinn Devitt on with the schedule.
It's a tight schedule,
Aoifinn Devitt joins us right now, Senior Investment Strategist, Moneta Group. Love having her on. Even Prime Minister Mitsotakis was collegial about the challenge of Europe. Can the fiscal debacle, which is Europe, can it affect America?
Very interesting question. Yes, better late than never. Great to be here again. In terms of Europe, Greece is actually a great example of a comeback kid when it comes to Europe. They have come from being one of the so-called pigs back in the day when austerity had to dominate. And they've really engineered their economy. They've focused a lot on tourism, and they really have moved it into that more positive phase. So I'd say that is certainly in Europe being touted, along with Spain as one of the comeback kids. So as to whether Europe is in the doldrums, certainly it is not experiencing the same resilient growth as we see in the US. And is lower inflation, even stagflation in some areas, if you look at the UK on the periphery of Europe there. So as to whether it will drag the US down, I don't see that. The US is firing on all cylinders on its own. I think as a trading partner, it's already gaining independence.
So, Aoifinn, one of the concerns here of the marketplace is, boy, this has been such a big run off of that April low. And if we've gone too far, too fast, are earnings there to support it? Is Fed policy there to support it? What are the conversations you're having with your clients these days about that?
We're having the conversations around some of this uncertainty that is circulating on the policy side, on the political side, geopolitical side. And then we're contrasting that with the resilient market performance, which has seemed like that Teflon market that has marched ahead regardless. So our clients are clearly pleased that their worries, which they are experiencing, are not being reflected in their investment portfolio. As far as whether we see there's a frothiness emerging, how we at Moneta are insulating against that is by going back to our diversification playbook that we've never really strayed from, but we're going back to kind of validate our strategy there. And that's diversification into small caps, mid caps, less exciting sectors of the economy. We've always had a linchpin of inflation resilient assets, such as infrastructure and real estate. They haven't been shining stars at all in the portfolio. And we've had that international exposure, which has finally started to earn its keep after about 10 years of languishing. Yep. Underperformance, as well as the dollar was weaker. So and the dollar being now weaker is making those performance even more compelling. So I'd say we are a little concerned about froth, but how that will manifest is in more volatility in the tech names.
Real quick, 30 seconds. Gold, what a star.
Gold has been a star. We tend to see that more through some of the picks and shovels around gold, some of the broader holdings within our portfolio. We don't have dedicated exposure to gold. I think gold, though, can be seen as an alarm bell, as a signal as to what investors are really thinking about the fiscal state and their concern about dollar debasement. So yes, It's a positive story, but what can we read into that?
Aoifinn, can't wait to get you into our studios here in New York. Ms. Devitt is Senior Investment Strategist at Moneta Group. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
From Trend Following, joining us is Katy Kaminski, really one of the leaders in the nation at AlphaSimplex on Trend Following. Let's go back to soybean futures and what John Henry, Monroe Trout, and a whole bunch of others did. What did they invent with Spark stations years ago?
So trend following is a strategy where you're looking at rules and you're looking over different horizons to determine the footprint of the market using math. And so what was exciting about their approach was they were following market trends using math. And today we do the same thing, perhaps with a little more math.
Right.
But
This is beautifully explained. And folks, what's so important here is they did this on Spark stations, which were unreachable. And then one day, Michael Bloomberg and Tom Secunda showed up with a mini Spark station called the Bloomberg Terminal. And all of a sudden, I had unit choice in looking at 5, 6, 7 trend following ideas. Which unit right now, Katy Kaminski, is most efficacious for staying on trend?
Well, I think if you think about units, we tend to think more about windows and frequencies as the most interesting. So longer term horizons have been more profitable recently.
Thank you.
But shorter term horizons have really struggled. So we'll see what happens.
So what are some of the areas right now that have your attention right now, whether it's stocks, bonds, commodities?
I think, who can't ignore what's going on in precious metals? I mean, that's been very interesting to me. I mean, we're talking about gold, but take a look at platinum, palladium.
I'm looking at them, GCLO.
Just really big trends. And that has been something that we've been certainly following because it is sort of at odds with sort of that things are looking like we might have cuts. So I think what we've seen recently is some new trends forming and some question about fixed income has been just really difficult. But otherwise...
So I'm seeing, again, gold up 42% year to date, silver up 55% year to date. I didn't see that one. Copper up higher as well. Typically for AlphaSimplex, is a trade that you guys put on? What's the typical duration of a trade you guys put on?
So trends can vary in size and length. And what's interesting with the gold trend, it's been going on for almost 2 years.
Right.
So some of these trends have emerged more recently. So particularly silver has been a trend that's been emerging more this year. Right. So it really varies depending on what the market environment is and what trends are prevailing.
Right. First question, I mentioned Peter from Connecticut today. The second question he asked me was, Tom, tell me about moving averages. I use Kleiman exponential moving averages where I'm looking at the area between them on a log y-axis. Okay, enough jargon. The bottom line for our audience, it drives me nuts when I hear a study of death cross. Katy Kaminski on the proper use of moving averages.
So if you think about using moving averages, it's really about looking at sort of what is the direction across different frequencies. So one of the best ways to combine these methods is to compare them and then look at them across multiple different crosses of moving averages and examine how much you're seeing that change across different frequencies of trend movements.
Are you looking at the tangent? If you take an exponential moving average, are you looking at the tangent of it over what time frame? 14 days?
So it depends.
14 units?
I'd say exponential moving averages are better than moving averages because they don't drop data points. So think if you have sort of an April 7th data point in there, boom, it will mess up all of your numbers.
Lisa Mateo's looking at me. Tom, you're such a nerd. Oh, save the interview.
So in terms of managing risk, a typical hedge fund might say, hey, if your position moves 10% against you, you cut it in half, and moves another 5%, you're just out, and don't come crying to me. That was when I was working hedge funds. That's what my PM would say. How do you guys manage risk in terms of movements?
This is a good question, and that's why trend following as a strategy is meant to be self-correcting, in the sense that as trends move against you, your positions naturally reduce. So as you see trends expand, you're expanding positioning. As you see them contracting, you're contracting positioning, all using math.
And I want to,
we don't use math.
The heritage of this, Good Morning 92.9 FM, is a guy named Ed Thorpe. I've had the great honor of speaking with him. A guy named Andrew Lowe, one of his disciples is Katy Kaminski here. And I should mention at Imperial College, Paul Wilmot, who changed quantitative finance. So within that, you get back to the basic thing that all of our listeners and viewers know is, okay, I'm going to be responsible. I own NVIDIA like I don't, and I'm going to have a stop loss. You don't do stop losses, but what do you do when you get a melt up, all-time highs, you get a pullback? How do you gauge when to get out?
So really, when you have sort of a reversal in signal, it's a combination of two things. One is sort of the reduction in the signal strength. The other is volatility expansion. So as volatility expands, you also integrate that in how you measure what your position sizing should be. So when you see, that's why you see a lot of quants struggle this year, because when you see those type of shocks, it's hard to measure it.
Paul, I want Paul to, I could monopolize the whole thing rudely. Paul, what she just said, folks, position sizing is the single most important thing. Silence. Okay, Paul,
there you
say
go.
me.
Fixed income, you said you kind of threw up your hands with fixed income. Why is that?
So fixed income has been, even though there's been a lot of talk about it, if you look at the trend signals, they're very range bound, and you've seen sort of long, short, but we've actually started to see more momentum in fixed income on the long side over the last 2 months, especially going into the first rate cut. So I think for me, that's going to be an asset class that could have trend potential. And this week was particularly confusing because you also saw yields going up on good growth data.
Right.
So the question is, could you have steepening of the yield curve? We love things like that.
Are you watching Tigers Red Sox from Miracle of Science, the bar?
Perhaps.
Get back in time to see the game?
I have to admit, I live right by Fenway Park, so I should probably head over
Really?
there.
Somebody said out on Twitter we should do a remote from Cask and Flagon tonight.
Sure.
That would be great.
Absolutely. Let's rip it.
It's exciting, isn't it? Katy Kaminski in studio in New York. She'll be back in Boston, no doubt, for the festivities this weekend. She's with AlphaSimplex. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We're going to do this right now. We're going to get right to it with Dan Tannenbaum. Daniel Tannenbaum's partner and global anti-financial crime practice leader at Oliver Wyman. He is brilliant on sanctions. 5 months from now, we are 4 years into a Ukraine war. So it takes a while for fancy people like at Oliver Wyman to get together and say, do this, do this, do this. There's a laundry list. China, India, Israel, Turkey, UAE, that are basically helping Russia by taking their oil, their product, giving them stuff, taking stuff, and that. What is Europe waiting for 4 years into Ukraine?
It's not just Europe. You've also got to remember the Trump administration has done literally nothing in terms of actual economic pressure on Russia. It's been like a perpetual state of Ted Knight standing at the T screaming, well, we're waiting. I mean, there have been no actions. It's been a lot of idle threats. Europe has already had a plan to wean itself off of Russian energy. They've already offered to expedite that by a year. The whole reason why these sanctions have evolved the way they were was to not cut off our nose to spite our face. It's a reason the Biden administration didn't push too hard in the last term, because they knew that Europe couldn't immediately go to zero. And so that they are going.
But now they can.
Now they can on an expedited timeline. It could mean increased prices, but there's still action the U.S. needs to take as well. There's really been a bifurcated effort over the last 9 months, whereas previously the UK, EU, and US were lockstep in line for 3 years.
And Dan, just looking at or listening to some of the comments from President Trump at the United Nations just this week, it seems like for Ukraine and for the Middle East, the president's almost like wiping his hands and saying, "You guys deal with it."
While his rhetoric has been as aggressively supportive for Ukraine at any point in this term, he's also setting himself up to say, well, I told everyone what to do to end this conflict. They didn't do it, so this isn't my fault. Like, that is where this is ultimately headed.
Do grizzled pros like you say, okay, where's the Senate, where's the House? Or is the sanctions world a very executive branch dominated thing?
The legislative branch had a role. In 2017, the Senate passed CATSA that went on against the president's wishes at the time. I've spoken with some of the senators that are involved in crafting the legislation. It's been basically written in a way that gives the president carte blanche. The Senate will not move on this without the president. And that is unfortunate because they have a role to play here.
So how do we think about some of these hotspots in the world, the Middle East, Ukraine? Is it simply at whoever gets into the president's ear last, that's what comes out on Truth Social? Or is there a State Department-driven diplomatic plan for either of these places?
What I know is that a lot of the Russia experts, for instance, are gone, that were career civil servants. There isn't as much depth as there once was. I can't say whether whoever is the last person in the president's ear is driving this, but it is unclear what tangible actions will be taken to actually execute against this disappointment that we keep hearing about in public remarks.
What are you thinking about this weekend? I mean, your remit at Oliver Wyman is so broad. What is Dan Tannenbaum studying this weekend in this dynamic sanctions?
Well, so I'm actually going to Brussels on Sunday to speak on a public event that Bloomberg is the media sponsor for.
There you go.
With the EU ambassador responsible for their sanctions policy. And we're talking about, are sanctions effective? And I think the question is, they've certainly had impact. But Russia's a big economy. It takes time. There's more that needs to be done.
Okay. But do sanctions come out of Brussels or do they come out of Paris, Berlin, Bonn, wherever? Do they come out of the individual countries?
Brussels is trying to align everyone, and the work towards the 19th package in the EU is well underway. That is that move towards expediting getting off Russian energy. It's where the discussions around what to do with the immobilized Russian assets, about $200 billion, reside in Europe. And you're seeing a lot more talk of actually putting those on the table to do something with, which will make a difference.
Are you taking Mrs. Tannenbaum?
She does not want to come.
There's a gauntlet of stores.
In Brussels?
In Brussels. Yeah, you wouldn't believe it. I didn't know this, but it's dangerous.
She declined the invitation to go to Brussels this time.
Very good. I'm shocked. Tannenbaum, thank you so much. With Bloomberg in Brussels next week, he is with Oliver Wyman, and we thank him for his efforts. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
It's a new era for us on the newspapers. Lisa Mateo now with our most popular segment of the day.
Oh, goodness. All right, the pressure's on. So this is a topic we've actually been talking about this morning. It's the big spending on AI and when it's going to pay off. A couple of publications had stories about this. So Bloomberg crunched the numbers, so I want to give it to you. Tech giants raised roughly $157 billion so far this year. And that's up from about 70% from the same period last year. Some are saying, you know what, maybe the hype is overblown. They're giving like similar, comparisons to the dot-com bubble. You had hedge fund manager David Einhorn. He warns that the spending spree could lead to a, quote, tremendous capital destruction, even if the technology proves transformative. So you get to the Wall Street Journal. They talked to Bain consultants. They estimated the wave of AI infrastructure spending is going to require $2 trillion in annual AI revenue by 2030. That's how much. So how much revenue is there now? Morgan Stanley says that last year there was around $45 billion of revenue for AI products. So you see the big difference there. I mean, it's a mix of subscription fees, right? We were talking about that for the chatbots, money paid to these companies, data centers, things like that. But it's that big gap.
I think this is a great article because it hits home to me. You got to start questioning some of this stuff. But, they say that I just have to wait and see it come to fruition in products and services from, companies far and wide. I guess it's going to happen, but wow, it better.
It is. It's going to be a wait and see.
Yep.
All right, this one's here for you, Paul. Okay, Bruce Springsteen on the cover of Time magazine. All right.
I missed this.
Yes. Okay, so he talks about a lot of things.
First of all,
yes.
There's still Time magazine?
Yes.
That's the point.
That's the point. Yes. Right. Yes. There you go. He talks about fame, family, therapy, like touring with the E Street Band. Also, you have the 50th anniversary of the Born to Run album. Okay. But the issue actually
5-0?
5-0, yeah. And the issue actually comes almost exactly 50 years after he was first on Time magazine. Yep. So it's kind of like this full circle moment. But the big quotes talked about President Trump, which he's talked about before. They've been exchanging bars back and forth. Yeah. He said a lot of things about him. He said a lot of people brought into the president's lies. This the president doesn't care about the forgotten. He also, though, poked at the Democratic Party, though, at the same time. And he said that they need an effective alternative party, or the Democratic Party has to find someone who can speak to the majority of the nation. So he really
Can I just say,
out. Yeah.
There's a lot of people doing fossil rock. He's not.
No.
He's not.
He's been more prolific in the last 10 or 15 years than in his entire career. And that includes the pandemic. The guy, and he's on tour all the time.
I play some with James Taylor. These guys are older, but they're not. It's not fossil rock in any way.
No.
It's great. What else do you have? Are you done?
Okay, no, not done. Oh, here we go. Okay, this one, NBC Universal, right? They're continuing negotiations with YouTube TV. They're battling over pricing for NBC's programming, right? So last night, NBC Universal launched this digital attack ad at YouTube TV. So they warned customers. They said to YouTube TV that they could lose access to things like Sunday Night Football, NBA basketball, WWE wrestling, Premier League, and also, yes, the Real Housewives. Sorry about that. But they also threaten a blackout, right? If an agreement is not reached by next Tuesday.
Isn't this cable TV 1980?
Yeah.
Exactly right. And so this is just trying to get paid as much as you can for your programming. They'll come to a deal at the last minute, but this is a little bit different because YouTube is a lot bigger than Comcast ever was.
Yeah.
And they have so much more leverage. So it's not going to be as easy for NBC Universal here going against YouTube, but they'll come to a deal.
And then you mix the Peacock in with it too.
Yes,
the streaming,
exactly.
And it's like,
but it's all about the sports. You notice that NBC
Yeah.
Universal led with the sports, NFL. So
Sure.
your Showtime and your and your YouTube TV. You need the sports.
You do.
All right, very good. Newspapers with Lisa Mateo. How about
Friday
that?
version.
Friday version.
Very
Absolutely.
good.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.